still struggling. You know, the labour force participation in the US is still historically low. So we think the Fed will only start increasing rates very, very gradually, reflecting that backdrop. Yes?
Can you just go to the earlier slide?
This one?
Yeah. I'm looking at the figures for net central bank buying. Does that reflect your views of inflation going forward?
Not a great deal. I mean, I think these many central banks, I mean, this is net buying, so there'll be some selling against that. But even so, you know, this is more about banks reducing their purchases because they think they've reached a certain percentage of gold in their holdings. You know, I took this slide a few years back. We were seeing larger net purchases. So I think it's just coming to this is not the end of it. This is approaching gradually perhaps the end of this cycle of heavy buying. And don't forget, a fair chunk of this is just natural buying by central banks with mining sectors. So the likes of the Philippines or Russia or wherever else it may be in South America. I mean, we're still buying out there in perhaps small pockets, not on the scale of India a few years back, 2008 I think, around there. But this is, for example, I don't know, banks in other locations perhaps where it's not always declared, because a lot of this is not always declared as well. It's an important point to note. But it's not as if the buying is the gross buying. Sorry, it's not as if the gross buying is at this level of 500 and suddenly a lot more selling coming in. It's just, I think a lot of banks have just reached their natural limits.
Right. I'm just talking from a hedging perspective of vis-a-vis the local central bank's currency. And since there's a market difference between 2012 to 2014 and 15, is that the view of central banks going forward that inflation is going to be benign? I mean, based on your figures that you put out there.
No, I understand what you're saying. I don't think central bank would necessarily think that. I think expectations, and that's maybe one factor which could be gold positive, 2 or 3 years out. So we're sort of stoking up inflation in the system, which hasn't yet come out, and maybe that inflation will be delayed, given there is still, in our view, quite a lot of excess capacity in the likes of the US. But I don't think that, in all honesty, 300 tons is still a fair level. Just because it obviously pales against the 523. I think the 523 and a few numbers before that were still just at elevated levels. And I think what we've seen is that, especially, for example, not especially, for 2013 2014, we saw perhaps more banks coming to the party and buying relatively small amounts. Maybe they're concerned, well, I suppose there's a number of factors. They're still concerned about the dollar and frankly about the euro, what's going on. And some of these banks, yes, there's obviously repatriation, which has nothing to do with this, but there are some banks that would perhaps like to own it and have it at home, so it's not in the reach of anyone else. So there's a number of factors, strategic as well as inflation related, to keep it driving that as well. But not to a significant level. What I can't tell you is how much of that 300 tons is natural mine related and how much of that is strategic. If you want to give me a card afterwards, I can ask our central bank person, we can let you know. So that sort of completes the gold portion. Oh no, yes, no.
Two questions.
Yes.
First is, what is the 95 or 70% cost of production for gold? That's one. Second is, looking at China, where a couple of retail stores are shutting down.
Yeah.
What do you assume in India? How are the margins changing? What is likely to happen?
For the mining costs, we tend to look now more at the all-in sustaining cost, which is initially put out by the World Gold Council, which covers not just the cost of running your mine itself, but the head office costs. So it's more of an all-encompassing number. And on that basis, they're around, on average, not 90%, but the average is around $917 in the first half of this year. So So that immediately gives you a sense, and that's the all-in sustaining, which is the most exhaustive cost measure you can, I think, look at. So on that basis, with gold at 12.30, and okay, we're not taking into account any local exchange rate factors within that, but on that simplistic basis, it's still a reasonable margin for miners. And but around, say, 1,200 gold, if we can look at that price, you've only got about, you have about 10% of mines that are loss-making or sustaining. But that means that the production costs, which exclude the likes of your head office, are lower than that. They're considerably lower than that. So the mines are not, generally speaking, under pressure even at these levels. Yes, they've had, of course, their margins much lower than when gold was even 1,400 in the recent history. And so what we've seen is miners have been aggressively reducing their costs. But how have they done that? They've been reducing exploration. So you're not feeling that now, but we'll feel that in a few years out. And that's important because even though mine production now is still rising, or is plateauing at a high level, from a gold price outlook, that matters 3 or 4 years out. Because now we start to see the exploration reduction now, start to keep production going forward. So that will be quite important. In terms of retailers' margins falling, I don't know. I mean, I haven't seen a great deal of that. I mean, I'm wondering how much would you see if you're selling it on a per gram basis? I'll throw it back to you. 50% down. I mean, I don't know. I suppose part of it is what is your turnover like as well? And although gold prices are weakened, the Indian market, has picked up, not a great deal. So I think we're still feeling the hit of that. And you've got the other uncertainty about the monsoon. Yes, the monsoon's improved recently, but it's been very sporadic. Although on average it may only be 10% below its long-term average. It's been, floods here, droughts there, and I don't think it's, I don't personally understand yet, when we step back and how that truly happened in the market.
And in India, the easiest way to calculate is the imported gold bar is 995 jewellery. What is generally sold in market is 916, so there is a clear margin of 7%, 7.5% there. They sell 916 at a price of 995, plus they mark up in terms of making charges and number of other things. So technically, again, that's my estimate. As of now, it's around 15%. That might reduce or how it's
Okay. How might it reduce?
And China, just taking an example of China, where so many retail outlets are shut down.
Yes.
So what can we infer for India? I'm talking more in terms of equity, there are more number of equity participants on here. Just to understand.
That's a very good question. I mean, yes, we've had those shutting down in China. I think, one of the, yes, we see margins falling here, but I think, maybe a partly a reaction to that is to, increase where possible, the branded side. Or if you're not a brand, then what can one do to say increase the 18 karat side? So I think there were ways that you could, perhaps partially offset that decline on 22. And I say partially, of course, but I think those are what we see. And we see that in other markets. We saw in Turkey a massive rise in 18 karat diamond. It didn't make up in kilos for they're losing their 22, because it's also a 22 karat market. But they don't really care about that because the margin was that much greater. So you don't have to do a like-for-like kilo in any sense of the word. So perhaps if we lose 15% on your, my 22, I'll make up 6% my 18 karat, my 9 karat, or 14 karat here. Diamond rises by 5%, and I don't mind. Like-for-like, in terms of my margin, I'm probably flat.
I have 2 questions for you. Am I audible?
Yes, please.
So my first question is basically, since you are gold expert, does US have any gold reserves in Fort Knox? That's the first. Second, if we assume that they don't have any gold reserves in Fort Knox,
Yes.
what is it that is stopping US government from declaring that? Because we have already seen the worst part of the US economy. Again, we don't have any currencies which are based on a gold standards as per se. So what is it that is stopping US government or Federal Reserve from declaring that there is no gold reserves in Fort Knox?
I think I don't on and so forth. So we've had no sales from the Fed. In our forecast, either 2 years out or 10 years out, we don't have any sales from the Fed. So we think it's all over the US and remaining there. So
Why is it so closely guarded a secret?
because it's their gold, and I wouldn't want to tell you what my gold is. I mean, I don't know. I don't think it is a closely guarded secret. I think it's more, and I'm sure you're not one of them, but I think it's more conspiracy theorists who would like to put these things out there, and I just think, I remember, a long time ago, it's a small example, going to in Bulgaria, and there were rumours that they had sold